Welcome to Subramani. Some queries from investors. So one question is, with equity markets correcting and interest rates so low, is it a good time to be investing, right? That's what, are there better investment options? Now the answer is, in the long run, for you to create wealth, you have to be in equities. Whether you like it or you don't like it, you have to learn about investing in equities if you want to invest for the long run. When I say long run, I mean 30, 40, 50 years. You have to be investing in equities. Even if you want to create a family heirloom, I don't know why people don't think of creating a wealth which can be just handed over from generation to generation, so that in case somebody needs to use it at some stage, they can use it. Look at the fact that Tatas and Birlas wrote off 30,000 crores in the, or approximately that, in the telecom business. It's not easy to write off 30,000 crores of your earned income alone. It has to be some kind of a heirloom from where you can draw. So over 170 years, if you have created wealth, somehow you have the ability to write off 30,000 crores, right? So that can happen only over long periods of time. So over long periods of time, equity will create wealth. Now, if you're worried about inflation, you need to understand that during times of inflation, it is bonds which will get hurt much more than equities. So you have to be in equities. Equity markets have corrected. Equity markets will correct 10% every few years, every 2-3 years, and once in a while it will also correct by 30%. Whether you take March 2020 or you take 2018, any of those times, there will be one violent 30% kind of a correction where you will have to sit calm. Selling off in that time could be one of the worst things that you can do. Investing more in those times would be one of the best things you can do. So does it really matter that the market is corrected and the interest rates are high? No, it doesn't matter, because it will continue to happen like this, right? Interest rates could come down even further, or interest rate could go up. Interest again goes through a cycle, so it could be a very longish 40-year cycle like it was in the US, or it could be a 3, 5, 7-year cycle like it is in India. Right now it looks like the market interest rates are headed up, but how long? If the interest rates go to 8.5%, let's say GSEC goes to 8.5%, looks very high but not impossible. Never guess anything with interest rates. So I'm just giving an example. I'm not saying it will go there. If it goes there, just the natural gravity will pull it down, because people will say, at this rate I can't do business, so they will stop borrowing money from the banks. So all those things will happen, and naturally the interest rates will come down. So people will raise more money by equity. So when people raise more money by equity, equity prices will come down. So all these things will happen when the same cycles will continue. Now if you are a 22-year-old boy or a 23-year-old girl and you want to invest for the next, say, 70 years, what are your choices? You have no choices. You have to put money in equity, maybe a small amount, maybe 5,000 per month, maybe 10,000 per month, maybe 500 a month, right? Mutual funds allow you to do that. They allow you to systematically invest over long periods of time with very small amounts. So just make a start. Don't worry about current interest rates, what market will do. Market will do what markets have to do. You have to do what you have to do. So just apne pe lage raho, Munna bhai, right? Don't worry about what the market will do. Market will continue to do what it wants to do. You don't have to worry about that. You just pick up a good fund in which you do SIP. That's it. Don't worry too much about what the market is doing. That's for the experts to worry about. Is it a good idea to continue an SIP even when markets are at high levels? The answer is yes. Whether markets are high or markets are low is something which you feel today. Like today the index is, say, 57,000. Let's say the Sensex is 57,000. 5 years later, suppose the index is at 1,07,000, just a wild number. Would you then regret that you didn't invest in 57,000, or will you be happy that you invested at 57,000? Take any point in time of history, markets would have been at a particular level and people would have said, oh my god, market is high, or they would have said market is low. But if you look at it after 5 years, 10 years, 20 years, normally the market is at a higher level. And if you have been doing an SIP in a good fund, or if you say, I don't want to invest in knowledge, I will invest in an index fund, that's also great. Because assuming that you had invested 100 rupees in 1979 and not touched it at all, today it would be worth about 90,000 rupees including the dividends, right? That's the kind of 900 times growth is what the market has given. Will it continue to give 900 times growth over the next 50 years? I don't know, but I know one thing, it will give you better returns than bank deposits. it will give you better returns than PPF. Very likely that will give you far higher return than PPF, especially over a long 40-50 years kind of thing. It is very likely to give you a good return, much better return than real estate and gold. So what you can do if you're afraid is you invest in some multi-asset fund which puts little money in equity, little money in debt, little money in gold, and little money maybe in foreign equities, whatever. So a combination, so that you can look at it and you know that this is not going to give you sensational, outlandish kind of return, but it will give you a decent return. When the equity markets are down, it will fall less. When equity markets are high, it will go up less compared to your friend who is doing an SIP in an equity fund. But then if you are seeking peace of mind, that's a good fund for you to invest. If you are a person who wants growth which is greater than the volatility, then you should put money in an equity fund. Remember one thing, those who compromise on volatility will compromise on risk. They will not get, the people who are willing to stand to greater volatility will very likely get a better return in their overall portfolio. So you need to understand that while investing. Thank you.